next speaker is a nationally recognized economist in the area of business and economic forecasting. He's an award-winning forecaster who applies academic expertise to solve real-world problems. And then he explains it in a way that even I can understand, and that's not easy. He has served as a consultant for governments and Fortune 500 corporations. He is a frequent guest on local and national media. Dr. Snaith holds a BS in economics from Allegheny College, an MA, and a PhD in economics from Pennsylvania State University. Please welcome the director of University of Central Florida's Institute for Economic Competitiveness, Dr. Sean Snaith. Thank
you. Good morning. Let me apologize right from the get-go. I've got more slides than I have time, but I believe they'll be made available for download. So if I'm skipping over some slides, I apologize for that. This is always my most daunting presentation of the year. I mean, this room is really filled with movers and shakers. So I appreciate you taking time out of your busy day to come here and join us. My presentation, I'm going to follow the same pattern that we use in the Institute each quarter when we go through our forecasting process, and so basically sausage making. And the way we do that, I usually use the metaphor of those Russian or Ukrainian nesting dolls. You know what I'm talking about, where you've got a big doll, you take off the top, there's a smaller doll inside, take off the top, there's a smaller doll inside that, all the way down till you get to this little itsy-bitsy doll that is highly coveted and fought over by my daughters. That's kind of the way we do it. We start off with the big doll, we do the U.S. forecast, then we move down, we look at Florida's forecast. After Florida is complete, we look at the individual metro areas around the state. And today we're going to get a little smaller still and take a look at our outlook for Orange County specifically. So let's begin there. We've seen some pretty good economic data. As 2014 was coming to an end, we had a November jobs report nationally that showed 350,000 plus jobs being added to payrolls. Real GDP growth in the third quarter was revised upward to 5%. That after a second quarter growth of 4.6%. So there was really a set of pretty strong data that was coming out of the U.S. economy as 2014 was coming to an end. And there was a lot of writing. I read a lot of articles and commentary about this data suggesting, wow, maybe this is it. The U.S. economy is taking off. This data would support that. Consumers are back. The labor market's doing well. And it sort of brought to mind, I don't know if you remember this, it's an iconic political commercial that Ronald Reagan ran in his re-election bid, the Morning in America commercial. You've probably seen that. Basically, you know, he was, and if you haven't watched it in a while, watch it. It's a stark contrast to the political ads that we see in modern campaigns. But his first couple of years in office were very difficult for the U.S. economy. We were coming out of the tumultuous 1970s. We had high unemployment, high inflation, and we had inflicted on ourselves, the Volcker-led Fed with assistance from President Reagan, at the time, the worst recession since the Great Depression. It was necessitated to break the hold that inflation had on the economy. And it worked, but we paid a high price for that to take place. So 81, 82, not so good. But when we got to 1983, the U.S. economy took off. And for the 6 quarters in a row leading up to the 1984 election, the U.S. economy grew at an average rate each quarter of 7.8%. Pretty heady growth rates. Well, you talk about 4.6, 5% the second and third quarter of last year. Those are pretty high rates, the fastest we've had in this recovery. So I kept asking myself, well, is this Morning in America again? And unfortunately, I don't think it is. I don't think we're embarking on another run like we saw then with extremely fast real GDP growth. I think we're going to remain, if you will, in sort of this pre-dawn twilight that we've been in since the recession ended over 5.5 years ago. I think growth will continue, but I think what happened in the second and third quarters is more of an outlier. One example, the 5% growth rate. In the third quarter, federal defense spending last year grew at a 16% annual rate as the fiscal year was coming to an end. That's not going to happen again in the fourth quarter. We're going to see that data reverse itself. So I expect to see GDP growth slow down as we get into the fourth quarter and the beginning of 2015. And I'll give you some more specifics. Why? I think there's still a significant amount of uncertainty. And we talked about this last year, and I'd say broken record, but maybe some people don't know what that is anymore. I think I'm like a corrupt MP3 file. I just keep saying the same thing over and over again, but we're still dealing with it. We've got the Affordable Care Act. 2015, 2016, the employer mandates kick in. And we've enacted that law sort of in a reverse manner, like if we're going to dinner, if you had dessert first, and then at the end of the meal you still have those Brussels sprouts sitting on your plate. Well, it's time to eat the Brussels sprouts in the Affordable Care Act. And I think this is going to have some impacts on job growth going forward. Dodd-Frank, we've talked about that as well. 37.1%. That is the number of percentage of rulemaking deadlines in the law which have been missed. That's 104 rules that should be in place right now to guide our financial sector, which are not. 94 of that 104, there's not even a proposal in circulation. And so that uncertainty over our financial sector remains in place. Fiscal policy, we haven't addressed any of the large issues like entitlements or tax reform. That's going to continue to be there. And then monetary policy. When will the Fed raise interest rates? That's what 2015 is going to be all about. And as the data comes out, my feeling is it's going to be later in 2015 and maybe even possibly 2016. But that remains yet to be seen. What's that going to do to financial markets? What type of uncertainty or volatility could come our way? And that weighs on economic growth, and it has. GDP growth in the 5.5 years of this recovery has averaged about 2.2%, well below the robust growth of previous recoveries. And I think we'll start to see an acceleration, but only a mild one, as this uncertainty gets resolved. And you look at the labor market. Yes, we're creating jobs. That 350,000 in November was 240,000 in December. We're back to pre-recession levels of payrolls. But what about the jobs we should have been creating all along? That doesn't take that into account. I think we'll continue to see job growth, but I think it'll be this 240 rather than the November number, which I believe was a bit of an outlier. But we're not at full potential in the labor market. The Economic Policy Institute's, I would say, leftward-leaning think tank in Washington, D.C., they have an estimate of both the number of missing workers in our workforce. These are people of working age, sound mind, sound body, who are not working, who are not participating in the labor force in any manner. I'll show you that number in just a second. But in order for us to get back to our potential in terms of the labor force, to fully utilize our labor resources in the national economy, if we were getting jobs at this 240,000 plus pace that we saw for all of 2014, it's still going to be, as you can see, 2017 before we're fully using all the labor resource in our economy. So we still have a significant amount of slack as far as the labor market's concerned, and that headline unemployment doesn't tell us that total story. So we've got a long way to go before we can talk about a completely healed labor market at the national level. The number of missing workers, the Economic Policy Institute estimates that at 6.1 million men and women. These are people that could be working, producing goods and services in our economy that, for whatever reason, are not. And they're not in the labor force trying to find work either. If you included those people in our headline unemployment rate, which, by the way, stands at 5.8%, and I think at any point in history, if you had just given me that data point and said, hey, the U.S. economy has a 5.8% unemployment rate, what do you think? How do you think it's faring? I was, labor market's doing pretty good. That's pretty close to full employment. That's not the case today. We're not at full employment. There still is a lot of slack in the labor force, and that's one of the reasons why wages and salaries haven't been growing very quickly. And I think that slack is going to take some time to be absorbed. If you included those missing workers in that headline unemployment rate, the actual unemployment rate, if you will, instead of 5.8, would be above 9%. So that gives you a sense of really what the true slack is still in our national labor market. So what is our outlook nationally? Again, we had pretty good quarters in the second and third quarter last year. I think we'll see growth slow down to about half what we saw in the third quarter, about 2.5%, for a variety of reasons. Again, some of those bursts were temporary, and those factors temporary that drove growth up to that 5%. And at the end of the day, when it's all said and done, for the full year, 2014, real GDP growth is going to end up being about 2.2%. The same thing it's been for the rest of the recovery. Consumers, we're doing better. Our housing value has gone up. We're recovering lost wealth. More of us are working, but that wage and salary growth is not there. And so consumer spending, while it's improving, still, again, is not as robust as we've seen in previous recoveries. One of the issues that a lot of people are interested about has to do with what's happening with oil prices. We've seen a precipitous decline in oil prices, and along with it, gasoline. I noted on my way in this morning it was under $2 now at the station by my home. So a really dramatic drop in energy prices. What does that mean? How does that impact the economy? I think there's sort of some arithmetic. Number one, every $1 decrease in the price of a barrel of oil will push down the price of a gallon of gas about 2.5 cents. Consumer spending on gasoline in the aggregate goes down $3 billion. It pushes down consumer price inflation, and it raises real disposable income. So there are some positive, tangible effects of the decrease in energy prices. What does it mean for the economy in terms of lower growth? Well, the impact ultimately of this decline will depend on two things. One, how low do prices go? And then secondly, how long will they stay there? We've been through these transitory periods of volatility. In 2008, you might recall, we went through a very similar dramatic swing, but it didn't last. But if it's permanent, some of the simulations that I've run, a $10 decrease in the price of a barrel of oil pushes up GDP growth in the first year by 0.2%, and the second year by 0.5%. So the longer these lower prices are in place, the larger the economic impact on the economy. Hey, it feels good not to put so much money in your tank. It happened at a pretty good time as far as retailers were concerned. A good time to have a little extra money in consumers' wallets during the holiday shopping season. What about domestic production? What is this going to do to North Dakota and Texas and Pennsylvania, places where shale oil has been in an amazing boom, creating jobs and wealth there? The longer prices remain at these levels, the slower growth in drilling is going to be in those areas. The average price of extraction in the Bakken shale fields of North Dakota is about $60 a barrel. So at $49, which is what it was when I checked on my way in this morning, that's not an incentive to add new wells. So we'll have to watch as that progresses, but there are some potential negatives. Housing market continues to pick up, not accelerating at an extremely rapid pace, but starts are rising. Interest rates remain low. What about Florida's housing market? We all know that was central to the cycle that we experienced, which, by the way, was a lot worse than we had previously thought. And I'll get back to that in just a second. Florida's housing market continues to recover. In 2012 and 2013, we saw double-digit price appreciation. That slowed in 2014 to single digit. There's still a high level of investor activity, and that you can gauge by looking at the percentage of residential sales, which are cash transactions. And financing, mortgage availability, I think is really still a potential fly in the ointment as we go into 2015 and beyond as far as the housing market's recovery is concerned. I want to share with you a little data from the Florida Realtors. These are sales of single-family existing homes. The red line is a 12-month moving average, and you can see it's been a steady upward trend with some bumps along the way from the low point of the housing crisis. And that continues to be the case, and we expect to see that growth continue. Prices, still a long way to go from where we were at the peak of the housing boom, but a significant amount of wealth has been recovered in the form of home equity. And we're seeing that, as I said, we're still moving upward pricing-wise, but the pace of price appreciation has slowed down into the single digits. Here's the latest data. You can see transactions, closed sales for November up 10% versus a year ago. Prices, 3.5% up versus a year ago, so more modest gains. Inventory following a little bit, still relatively tight housing market and leaning in favor of sellers at this point still. We talked about investors. How do we know investors are active? Well, there's anecdotal information certainly, but if you look at the high share of transactions which are cash. Private equity, hedge funds, they're buying Florida homes, buying residential real estate. Why? Well, the same reason they buy anything else. The expected return is attractive to them. And you can see, if you look at median rents in Florida and the median home prices, how high these yields were and why that attracted so much money. That is not a, 10% yield on a home that you bought and then rent out is not a bad return. And I think a lot of these investors see that. They also see prices rising. So hedge fund comes in, buy up a bunch of homes, turn around, rent them out. You get a nice yield while you're renting them. Sell them in 3, 5, 7, whatever their holding period might be. There's a capital gain on the back end of that. So that's why we're seeing this investor activity. It's an attractive investment. But as prices rise, those yields, as you can see, are falling. And so the shine starts to dim a little bit on investors, to invest on housing in the eyes of investors. And that money eventually is going to go somewhere else to an investment that has a higher expected return. How do we transition from BlackRock to Mr. and Mrs. Black in the housing market? And that's my concern, because the mortgage market remains relatively tight. And I want to show you some data that will reflect that fact. This is looking at the major metros in the state, cash transactions, and you can see there in the final column the percentage of all transactions which were cash. And they still remain high, 40% statewide. I mean, down from close to 50%, but still, talking to economists in that sector, 10% would probably be a normal share of cash transactions in Florida's housing market with international buyers and so forth. So we're still in this unusual housing setting right now. Talked about credit availability in mortgages. It's not easy to get a mortgage now. It's still rather tough. And the Mortgage Bankers Association of America has a credit availability index they put out. And this is an index number, and so you benchmark index numbers to a certain time period, and it allows you to make comparisons across time periods more quickly. They benchmarked, in this case, to March of 2012. So the credit availability index for mortgages has a value of 100 in March of 2012. So that whatever credit availability was in March, that value gets 100. The most recent number you can see in October, it's at 115.7, that index. So what does that mean? Well, mortgages are 15.7% more available now than they were back in March of 2012. So we've made some improvement. But to get an idea of where we've come from, look at the dots that are earlier in this chart. They weren't putting out this index back in 2006, but they backcasted it to that time period. And you can see that the index number in 2006 was something on the order of 886. So we went from 886 in terms of the availability of mortgages down to 115. That's a pretty dramatic swing. Now, I'm not saying we should have been here, but I don't like the fact that we're here either, and we need that pendulum to come back a little more to the middle if housing is going to be able to continue its recovery without too much disruption. Housing starts in Florida continue to rise. Florida's economic recovery, in part, has been fueled by a resumption of population growth. Retirees whose plans were delayed by the financial crisis, the housing crisis, the economic recession, are able to retire again. And we're seeing those influx, and that's helped Florida's economy recover. Now, I mentioned Florida came out of a much more profound recession than we originally thought. Data this summer was released that showed that Florida's economy continued to contract in 2010 and 2011. Florida real GDP contracted both those years. So that's 2.5 years longer in recession than the national economy was, which makes our situation right now, I think, all the more remarkable, because Florida is growing faster than the national economy. We're producing jobs at a faster rate than the national economy. So while it might not be morning in America, the sun is certainly shining on Florida as far as the economic recovery is concerned, and we expect that to continue. And the unemployment rate, you can see the historical trends here. Real gross state product, which I just mentioned, that was a long recession, and I think you could make a case that we went into recession ahead of the nation. It was April of 2007 when Florida started to lose jobs. So this has been a multi-year severe downturn, one from which we're clearly bouncing back after a long time coming, that's for sure. Payrolls are still not back to pre-recession levels in Florida. We expect that to happen this year. But again, that doesn't say anything about the jobs we needed to be creating all along. So there's still work to be done in Florida's labor market. The construction sector, very high growth we're seeing. A lot of that is because so many jobs were lost when the housing market collapsed. I'm going to skip ahead here because I promised to stay on point. Leisure and hospitality, this sector has been one of the earlier sources of growth in Florida's economy. It's continued to surprise me in many ways that it's been able to maintain the momentum for as long as it has since the early parts of the national recovery. Looking over the next 3 years, average growth, the sectors we think are going to be creating the jobs the most rapidly: construction, professional business services, probably many of you fall in that category, white-collar jobs, trade, transportation, utility, leisure, and hospitality, and on down the line. Health continues to grow as it did throughout the entire recession. That's not going to change, given Florida's demographics and given policies that are currently in place. Looking at the Orlando metro area, the second fastest in terms of population growth that we track, only behind Naples. Naples is small. Naples attracts a lot of wealthy retirees, and so with the stock market and bond market booms that we've been experiencing, they've been in Naples experiencing a boom as far as retirees. And so that's why you see the higher figures. We're the fastest growing large metro in the state in terms of population growth and in terms of job creation. Okay? And that's likely to be the case for some time to come. So you look at the Orlando MSA, which sectors are growing here. This is the four-county area, and similar to what you see at the state level, with the exception of leisure and hospitality. That's growing more rapidly here in Central Florida than it is in the state overall, and you know, we certainly understand why that's the case. This is an important and large sector in Orlando, and it continues to get stronger, and it continues to create jobs and contribute to the regional economic output. Well, what about Orange County? Okay, we're down to that eensy-beensy little doll that my daughter's always fought over. What's the outlook for Orange County going forward? The outlook's very bright. The sun is shining on Florida's economy. You need to wear shades in Orange County. It's so bright. That was a really bad song. I can't remember who sang it, but things are looking remarkable here, particularly given where we've been, how quickly we've come, and the outlook going forward is really quite robust. Real gross county product, so basically GDP at the county level. In real terms, by 2017, we should be an $80 billion plus economy. That growth is fairly steady. Population growth, primary driver of economic growth, is strong in Orange County and is going to continue to be the case. That will create jobs, that creates economic activity. I mean, that's, more people means a growing economy. It's as simple as that. Looking at some of the sectors here, overall job growth, again, as the mayor said during her introductory comments and has been noted by the national media, we're creating jobs at a very fast clip here in Central Florida and in Orange County. And Orange County is about 70% of the metro area in terms of jobs or in terms of economic output, just for your information. So payroll jobs continue to grow at a pace faster than we see at the state level and much faster than what we see nationally. Construction employment on the uptick, a lot of builders grumbling that they can't get workers that they need. All those 340,000 construction jobs that were lost, we didn't put those workers in cold storage until we needed them again. So it's not surprising that we're seeing some issues with availability of labor as the construction sector picks up. Education and health, and you can see that right there. Throughout the recession, it continued to grow. Created jobs. Why? Well, we're older, generally speaking, and demand for health services will continue to grow. The Affordable Care Act is expanding coverage to some extent so far. That means additional demand for health services. That's a sector that's going to continue to grow. If you don't believe me, drive out to Lake Nona and see the fruits of all those labors really being harvested right now. There's a remarkable amount of economic activity that's spilling over beyond higher education and the public sector into the private sector as well. And I think that's going to be a source of growth and of diversification of our economy. I know we talk about that a lot. It's tough to do, especially when you've got a sector like tourism that is so muscular but won't stop going to the gym either. So that sector gets stronger and stronger. So yeah, we're doing a good job creating jobs in other sectors, but if you look at shares of the economy, the progress won't be as evident, is my point. But let me zip through some of these other ones. Professional business services in Orange County, financial activities. That sector, generally speaking, they're waiting for these rules to be implemented. They're stuck in this no person's land. Where they don't know what the rules of the game are, they don't know how to play it, and they're just waiting for Dodd-Frank to either be implemented or to be amended, perhaps, and reduced in terms of its scope. Manufacturing, not a huge sector, but a little bit of job growth there. State and local government with high population, high economic growth. The need for state and local government services continues to grow, but at a fairly modest pace, especially given the economic growth that we've experienced. The trade, retail, wholesale trade, transportation, steady growth there. Some of that, of course, is fed by the hospitality sector. So let me just summarize, and I think I actually stayed on time. Let me just summarize my comments this morning. It's not quite morning in America yet, but the sun is shining on Florida. It's shining even more brightly here in Central Florida. And if you look closely at that eensy-beensy little doll, she's got a really big smile on her face right now. Thank you.
We do a few questions. We do have a few minutes. Thank you for staying on time, which made time for questions.
Yeah.
You did it.
Yeah.
You did it. So we would like to take some questions from the audience if you have some. Let me start off with, we've talked about job growth here. What spurred that, and what can we do to continue that momentum?
Well, I think, you look at the efforts, and I said Medical City sort of is a standout thing, but you look at the policies and the efforts of the public and the private sector, all these partnerships that don't happen in other parts of the country, I think have really borne fruit. That's the kind of things that we continue to do, actually. It doesn't stop here, and it works. And when I do, and I know you travel around the country to speak as well, people are genuinely curious about how that happened. It's a sort of a mind blower that so many different parts, public, private, state, local, can all come together and agree on something and work towards a common cause. It's not like that in a lot of the country.
Do we have a question from the audience? Can we get a microphone over here?
Okay, Roto here. Sean, is there a cookbook for you talked about the fact that diversifying economies, and especially when you got the big weight room thing going on, is not easy. Okay,
Yeah.
So, in your world of the economic competitiveness, and you do a lot of benchmarking and everything like that, is there any good cookbook on how you actually nurture the interdependence between all these nodes of the economy and actually make all the boats rise in the tide?
Well, this is Rick Weddle's bailiwick here, so I don't want to step on his toes. He's got those answers, but in my mind, how do you make all boats rise on the tide? Well, I think if the economic environment nationally were more robust right now, we'd be growing even faster here in Central Florida and Florida. We're not immune to what's happening at the national level. We're not immune to what's happening globally. But I think if some of this uncertainty could be peeled back And really, that was one of the big reasons that we had that mourning in America during Reagan's first term, was that the uncertainty of high inflation was finally, once and for all, sort of slayed. That dragon was put down, and with that gone, the economy really was able to take off. So I think as uncertainty resolves itself, either by time passing or by deliberate policy action, growth will start to pick up as well. And like you said, that's how you lift all boats. With overall economic growth and create jobs. And really, this weak labor market, to me, nationally, has been really the root of a lot of the problems subsequently that have come up politically and socially as well.
I think we have time for one more question. Can we have a microphone over here? If you would stand up, sir. Thank you.
I just wanted to get your opinion on the deferred deportation, the illegal aliens becoming illegal or whatever. I know in terms of construction, around here, hospitality, service industry, what effect do you think that'll have going forward, or the additional labor coming into the...
Well, I'm certainly not smart enough to understand the politics of it. But I mean, obviously, immigration has been a huge political issue here and one of great contention. Speaking just generally, I think we need to fix immigration. I think to maintain our economic growth and our standard of living, we need to have immigration. And we need to have a higher rate of immigration than we currently have. We don't want to slip into this further into this European malaise where you've got 1% population growth. That's a rate which means you're going to decline over time. You need about 2.1 for your birth rate to be able to sustain or to grow your population. So, this is one of the lasting impacts of 9/11. I think it really just put a lot of stress on that aspect of our economy. So, I don't know what the answer is. Amnesty granted immediately to everybody. I don't think there's going to be self-deportation. I think there's going to have to be some compromise where people on either side of the issue don't like the solution, which usually means that we've got a good solution. But it has to happen.
Thank you for your time and your insights. Appreciate that.